Good morning, good afternoon, good evening, wherever you're zooming in from today. Thank you for joining us. We have an important conversation today in the current environment that is so much different than it was just a few months ago. We're going to be talking about the changing demand for credit, not just in the US, but around the world. And we've got nobody better to speak about that than Gary Mendel, who's the president at Meridian Finance Group. Gary's the president. He has formed the company. He's an expert on credit insurance, and trade finance. They offer finance tools to help companies grow their business internationally. And so we're really fortunate to have Gary talk today. A little bit different format than normal. We'll be going about 45 minutes with the presentation, and then we'll have about 15 minutes for questions. Please type your questions in to the into the section within Zoom, or send them to info@globalchamber.org. My name is Doug Brunke. I'm the founder and CEO of Global Chamber. We bring these types of information programs to you so that you can be more successful with your international business. And so we're very pleased to have Gary here today. Gary, please go ahead and let us know more. We're very anxious to hear what's going on around the world and how we can help with this information to grow our business.
Thank you. Can you hear me okay?
Perfectly.
Super. Okay, I'll get started. Hi, everybody. So what we're going to talk about in the conversation today is the evolving demand for trade credit in COVID time, and talk about tools and techniques for managing the credit so you can keep doing business if you're in a sector that's fortunate enough to still be doing business. Demand for trade credit has been increasing for some years. Buyers have been pushing back on suppliers for longer credit terms, bigger amounts of credit than suppliers normally or previously would have been prepared to extend. So a company may offer 30 days payment terms as its standard credit offering on its invoices. But in the past few years, more and more customers have been pushing back saying, well, you can put 30 days payment terms on your invoice, but we're going to pay you in 60 days, or we're going to pay you in 90 days. And this has become a conversation that more than a few years ago you didn't really hear. This happens not only in individual relationships between a supplier and a buyer, but also in larger and more important supply chains. For example, Boeing a few years ago said to all of its suppliers, you know, we don't care what you put on your invoices for payment terms, we're going to pay in 120 days. And of course, this has effects not only on those immediate prime suppliers to a Boeing, but down all of the suppliers down a very broad and deep supply chain, you know, with more far-reaching effects. But all of these impacts of customer pushback and other changes in the demand for credit over the past few years have now been compounded severely since the outbreak of the pandemic and with the economic impacts of that. Your customers now are facing more limited access to working capital than they have already. And if they're in other countries, it's even more so. You know, whether companies are borrowing from the big money center banks, regional banks, community banks, non-bank asset-based lenders, equipment leasing companies, receivables factoring companies, investment bank, you know, getting their financing from investment banking or private equity or hedge funds, across the board, capacity is a lot tighter than it was. Beyond working capital, beyond cash flow, companies are suffering from diminished financial flexibility, meaning on their balance sheets. They're becoming more leveraged, and that gives them less flexibility to pay. And so it results in them putting more pressure on their suppliers to step in. If the banks and other non-bank lenders are not coming through with as much capital support. If companies' balance sheets are being squeezed, this is where they're looking to their suppliers for bigger amounts of credit and longer payment terms. Furthermore, your customers are getting paid slower by their customers. So to the extent that your customers don't choose to pay you or can't pay you until they get paid by their customers, this is again putting pressure for longer payment terms. Your customers are having to source goods through supply chains that are compromised or downright broken. You know, bear in mind that if your customer is not only buying materials from you, but from, say, 10 other suppliers in order to build what they build or make what they make or sell what they sell, even if 9 out of 10 of their suppliers are able to have maintained supply chains and only one is suffering from issues because of a country it's in, because of a sector it's in, where there have been lockdowns or you know, shutdowns or other compromises to supply chain, if your customer cannot get that one component they need or not get it timely, that's going to push out their ability to pay. Your customers you may be operating with their people remote, or even if their people are able to come into the facility, into the company to work, they're operating with physical distancing. And while now that we're a few months into COVID time, we're beginning to get more capable at operating with people not all being in the company every day, or with people having to work through physical distancing. But it's not like any of us have years of experience doing that. We're all still learning. We're all still getting this sorted. I mean, basically, your customers are contending with uncertainty. We all believe there's going to be a recovery, whether, you know, regardless of what you think the shape of that recovery is going to look like, whether it's going to be a steep V or a long W or whatever. We all believe that there's, you know, a growing amount of pent-up demand for goods and services, both in the U.S. and globally, and that we're going to see a resurgence of growth in global trade and in the economy. But nobody, I don't care what they tell you, what the pundits are saying, nobody knows when that's going to happen. And even when we get past the social and medical issues of COVID, you're looking at another, you know, set of months or years for the economy to fully recover. And that uncertainty is part of what's driving things. Your customers who are in business and who have a long-term plan and are fortunate enough to be in sectors that they can have a long-term plan, are trying to plan for an eventual recovery. But in the meantime, they're dealing with change and uncertainty where things can shift on even a daily or a weekly basis. Beyond you reacting to your customers' demand for credit, there have always been reasons for you proactively to want to give credit. And again, these factors have become much more acute in COVID time. You want to give your customers credit now so you can book more orders while opportunity still exists. You know, you may have customers who have continued purchasing from you since March, when this all, you know, got started in this country. But there's some uncertainty as to whether they're going to be able to continue purchasing from you for the long haul. You know, this is going to be going on into 2021 and beyond. So while opportunities still exist, you want to make the sales now. And part of making the sales now is going to arise from you giving sufficiently competitive payment terms. You also want to outsell your competitors who are still out there by giving more competitive payment terms. You know, once upon a time, the reason that a customer would buy from you instead of from a competitor was all about price differences, or your product being more reliable, or your product being available in blue and your customers was only available in red, or any number of other factors. Payment terms has not traditionally been as big a situation, because you would give net 30, your competitor would give net 30. That, you know, there wasn't much difference, not much differentiation. Today, that's different. You may find that a company may say, look, we really want to buy yours more than your competitors, but your competitor's offering us 90 days and you're holding us to 30. When you give your customers more credit, it helps you produce or purchase more efficient quantities, whether of finished goods if you're a reseller or of materials if you're a manufacturer. It helps you to strengthen your throughput and strengthen your supply chains because you know dependably what kinds of orders you're going to have going out the door. Importantly, payment terms get your distributors to take more inventory. One of the phenomena we've been finding during COVID time is that our clients' distributors have been allowing their inventory to dwindle or to run out completely, and that the distributors are looking to our clients to have the inventory available so that if the distributor receives an order, then they can come to the supplier and say, look, I need you to ship this right away. You know, you've got to get me the product immediately. Otherwise, the distributor up the road is going to get the order and not me. Or if I can't get it from you immediately, I'm going to have to get product from a different supplier, not from you. So what's happening is the traditional role of distributors to stock inventory and to allow the manufacturer to transfer inventory carrying costs to the distributors has been compromised in COVID time. And the problem is you carrying your own inventory is expensive. You want to move that on to your distributors or onto manufacturers who also may be looking to you to hold inventory for them rather than getting it over to them. Another benefit of giving longer payment terms, besides getting your distributors to stock more inventory, is that it causes your products to get staged nearer to the end users of the product. And that's also very important now in this time of compromised supply chains and compromised logistics. You want your products to be as close as possible to the end users who are going to be the ultimate consumers of your product. So once you cross that Rubicon of recognizing that you're going to need to give more credit and longer payment terms in order to remain competitive and remain as successful and as profitable as you can be during this period, now you have to deal with the challenges that go along with that. And the two main challenges with giving more credit and longer payment terms are contending with the risks of not getting paid and the working capital challenges. And we'll talk about those, in sequence. Again, non-payment risks have always existed when you give open account payment terms to customers. But now they're becoming more acute in COVID time because more companies than ever are filing bankruptcy, both Chapter 11s for reorganization and complete liquidations. Companies are going out of business at an unprecedented rate, and there's a lot of concern that this is going to pick up in pace as the year continues. Even for your customers who are still in business, they may be facing considerable cash flow or working capital challenges that could result in them not paying you or paying you slow. And as we said before, beyond these cash flow issues, there are also balance sheet issues of companies becoming excessively leveraged and thereby not having the flexibility to be able to pay all of their suppliers or all of their creditors equally timely. And so are you going to potentially be one of the suppliers that is further down the priority list and therefore getting paid more slowly or not getting paid at all? As your customers face uncertainty in their supply chains or downright lockdowns of their business or of their supplier's business, again, this could result in them not being able to pay. Beyond these kinds of effects of the pandemic is the risk of the pandemic masking underlying problems. Plenty of companies, plenty of your customers had issues that were not necessarily as visible, or maybe they were visible to you, prior to the outbreak of the coronavirus. The challenge now is seeing through the pandemic to those. Are you dealing with a company not paying you that's not paying you because of the pandemic, and then you can make certain decisions about how you feel about, what that future looks like, based on how how you think these circumstances are going to evolve, or is your customer not paying you because of underlying issues that would be there with or without the pandemic. One of the things we've had to caution some of our clients is to not view everything through the lens of the pandemic. Because there's not only the risk of your customer BSing you, that, I'd be able to pay you just fine if it wasn't for this, COVID-19 and its impacts, which may or may not be accurate. But beyond that, you need to be careful to not view every slow payment from a customer only through the lens of the pandemic. Because the reason your customer is not paying you might be them, intentionally using this as a spurious excuse, or it could just be your customer, or could be how you're looking at things and assuming that that's why your customer's not paying. In addition to the credit non-payment risks, there are also the challenges related to working capital. And there are really three factors that contribute to this. Number one, payment terms are growing longer. 90 days is the new net 30. The economic impacts of the pandemic are extending trade cycles out, driving demand for payment terms of 60 days, 90 days, 120 days, sometimes even more. This is compounded by customers paying slower, which depends on your customer's access to working capital, how much cash flow they've got to be able to pay you, their payment morality, because, again, COVID's not bringing out the best in every company. And some companies who, maybe their payment morality was not put to the test historically the way it has been since the outbreak of the pandemic, now are showing that, if they can get away with paying certain suppliers, perhaps you, slower, that's what's going to happen. And then, of course, there are the real world impacts of the pandemic. So you may have a customer who, through this whole pandemic, never doesn't pay you. They pay you every time. Even if this goes on for another year or more, they're going to pay you. But if you're giving them net 60 days and they're paying you 60 days slow, that means you're waiting 120 days for your money. So unless you've got plenty of working capital, how do you, in that circumstance, continue taking new orders, pay the light bill, continue paying your employees, and so on? And so these factors are then juxtaposed with the challenge of you obtaining working capital financing on your receivables. Receivables are more difficult to finance now. Banks are facing regulatory challenges, and all lenders, banks and non-banks, are facing credit challenges to financing accounts receivable. Under these circumstances, where now what used to be 30-day receivables are now 90-day receivables, where more and more receivables are being paid slow by customers, by debtors, where there are more and more concentrations of risk because companies that were selling to 20 customers may now be selling to only 5, only their 5 biggest may be hanging in there. And generally during the downturn, lenders are concerned about, whether it's their management or whether it's their auditors coming back to them later and saying, what were you thinking? Being willing to finance or take as collateral these receivables that were 90 days receivables or were being paid 30 days slow and so on. I mean, there may be perfectly viable reasons to take that on, but it's easy to understand why lenders are cautious. So in the face of these challenges, how do you keep doing business? How do you rise to addressing this demand for credit? Step 1, carefully reevaluate your customer's creditworthiness. Then extend them reasonable credit terms based on your decision. I get it completely in saying this, that if you have a customer who you've been dealing with for 10 years and giving them credit and there haven't been problems, that to go back to them today and start asking them for information about their financials or about other things or trade references could really fly in the face of that relationship. And this is much worse in certain international markets, where doing so in Latin America could raise real questions about your relationship, or doing so in Asia could really be taken as a loss of face. So I don't say this lightly. The point here is, in thinking about your strategy and thinking about how you maintain a secure credit position in terms of your customers' management of your credit and your receivables and your extending of credit, if you could obtain all this information to get a better sense of how your customers are doing now in the last few, after these last few months of dealing with things in COVID time, it would be really good information for you to be able to have. Not that you're necessarily going to be able to get that in every case, but it's how you're trying to position yourself where you can in terms of understanding your customers where they are now. Secondly, obtain credit insurance to protect the accounts receivable against non-payment risks. And third, if you're short on working capital, finance those receivables, which you're going to be much more able to do if they're insured, because insured receivables still look like a more secure bet to a bank or some other lender than uninsured receivables, especially in these times. So digging a little deeper into this question of looking at your customers' creditworthiness, reevaluating the creditworthiness. It's understood that you may not be able to get your customers to give you bank references or give you trade references from other suppliers, but it depends upon your circumstance. If you've been shipping to a customer regularly, monthly or twice a month since the outbreak of the pandemic, well, you're getting your own picture of how they're managing to pay in these times. If you don't ship as frequently to customers and you now are getting the first order from your customer that you've gotten since, say, February, you don't really know much about how, what does history pre-COVID tell you about how they're going to pay now? You don't know. So you are within your rights, if you can do it without compromising the relationship, to ask your customer, even if it's a long-standing customer, for references from other suppliers. So you can talk to other suppliers and see how they're doing in COVID time. Again, nothing is as telling as your own ledger experience, because regardless of how they're paying other suppliers, how they're paying you is really what you care about. Getting financial statements from customers always has been important if you can. That's been challenged somewhat this year because audited statements have come much later. Many companies that usually publish their audited annual financial statements in March or April or May not have done so yet, even though we're coming into late summer, because their auditors have not been able to come out and do physical audits because of physical distancing. And so and this is even to get December 31, 2019 audited statements. What you really want now are June 30 interim statements to see how the company's doing this year. Many companies, either because they don't want to or because they have faced delays out of their control, have not put out their June 30 figures yet. But to the extent you can get interim numbers, this is really helpful, because what does December 31, 2019 tell you about COVID time? Not much. Well, not anything. Credit bureau reports, as always, from Dun & Bradstreet, Credit Safe, Gradon, Skyminder, any one of any number of other services. We all use them. In our shop, we tend to use them as secondary information, not primary, to help us triangulate in on the other information we're getting as more primary sources. Some credit bureau reports are now advertising, their COVID indexes to try and give you some scoring mechanism on how well the debtor, should be positioned to pay in COVID time. We think these are pretty disingenuous. We think they're just sales gimmicks to try and sell the reports. Nobody knows enough after this short amount of time that we've been in COVID, and definitely nobody knows enough about predicting the future to come up with something like that. But credit bureau reports fundamentally serve uses. You know, they tell you about suits, liens, judgments, other public records, registration information of the company, and so on. Industry creditor groups are very important, whether through the National Association of Credit Management or the Credit Managers Association or other organizations, or just ad hoc groups of suppliers that form up and talk about their common customers or the countries they sell into. There's more information available online than there ever has been. And of course, as we talk about technology, can you do virtual site visits? You know, can you have your customer or some third party go into your customer's facility with a phone or with a laptop or with something, camera, that you can see what's going on there, what kind of activity is going on in the plant and so on, which you can then compare with what you saw historically, you know, when you were able to go visit them physically, or to set a baseline so that when they come to you for even more credit 6 months from now, you have something to compare it with. Part of the key to continuing to extend competitive payment terms to customers, and to do so in a way that you can do with confidence, is to use trade credit insurance. Credit insurance protects accounts receivable against non-payment risks. If you've got credit insurance and a customer you're selling to is covered under your policy and they default, meaning you gave them 60 days and now it's 61 days and they're past due, and then if that debt can't be collected, then you can file a claim and get indemnified under the insurance policy. So by protecting you against not getting paid, trade credit insurance enables you to extend more competitive payment terms to your customers, to do so with confidence that you're going to get paid, which enables you to continue selling even in a downturn, even in a recession. It can increase the profitability of your sales. For example, what I described earlier about transferring inventory carrying costs from your location to your customers, whether they're manufacturers or distributors, which makes your sales more profitable. And it enhances your borrowing capacity because if you're trying to finance your receivables with a bank or with a non-bank asset-based lender, insurance can make all the difference in terms of getting a lender to step up, or even if you are already financing your receivables, it can potentially get a lender to give you a higher advance rate against those receivables. So just a couple of notes about credit insurance in general, and then we'll talk about using credit insurance in COVID time. So credit insurance policies are available to cover all of a company's receivables, just its key buyers, its largest exposures, or various other kinds of spreads of risk. Is it possible to buy a credit insurance policy on just a single customer? Yes, but it needs to be a really strong customer. The principle for credit insurance mostly is to cover a spread of risk so the insurer knows they're sort of getting the good with the bad. If you want to cover just one, it needs to be a strong credit. Premiums are low, typically a fraction of 1% of invoice amounts. Claims, if you have a loss, if the reason your customer didn't pay you is because they went bankrupt or otherwise went out of business, then you'd want to file your claim as soon as possible. On the other hand, if you have a customer who is still in business but just is slow in paying you, and it's a good relationship customer, and you don't want to bring the hammer down on them right away, you don't have to. Credit insurance policies provide for an extended period of time, up to quite a lot of months, that if you choose, you can have time to work with your customer instead of having to bring the hammer down right away before you would need to file a claim. Under a credit insurance policy, the ticket is each customer needs to be approved for a credit limit, but there's various ways that can be done. Some policies, The insurance companies make all the decisions. They have broad and deep databases of debtors all over the world. And you can just go to the insurance company and say, hey, I'd like to extend $500,000 of credit to this company on 90 days payment terms. May I? And the insurance company makes the call. At the other extreme are insurance companies who don't even look at who your customers are. They're more depending on your credit procedures, your history, your track record, how you do things. And then the insurance company may go so far as to give you the discretion to keep making your own credit decisions and cover you for that. Most policies are a hybrid between these extremes. Where does credit insurance get issued from? Various different insurers. There are multi-line carriers who offer all kinds of insurance, commercial insurance, personal insurance, life insurance, everything. And they also offer credit insurance. So examples are names you'd know, like AIG, Chubb, The Hartford, Zurich, and so on. There are specialty insurers who offer multiple different lines of insurance, but all different specialties like surety and bonds and so on. And one of the types of coverage they offer may be credit insurance. These include companies like Great American, Houston Commercial Casualty, Liberty Mutual, and others. There are what are called monoline underwriters, who the only type of insurance they write is credit insurance. The three that have been around the longest are Euler, Coface, and Atradius, which are all headquartered in Europe but have been well established in the US for many years. And then there are some newer to market companies, one of them being Receivable, which is backed by Nationwide. There are government agencies, which in some countries can support both domestic and international sales. In the US, we just have the Export-Import Bank of the US, Ex-Im Bank, which supports export sales only with credit insurance. And then outside of the US, you've got other markets in Europe and Asia, the biggest one being Lloyd's of London. In the US right now, you've got between 24 and 30 insurance companies altogether that write credit insurance. In Lloyd's, you've got close to 50 Lloyd's syndicates who write credit insurance. Our company, along with other services, we're a credit insurance broker. We work with every one of these underwriters. We work with every insurer in the world that writes this type of coverage. More on that later. So to review, credit insurance is a tool. It's a risk management tool that protects your AR against not getting paid. It's a sales tool that can help you sell more product and do so more profitably. And it's a financing tool that can help you get financing for your receivables or to get a higher advance rate out of that. So what's happening with credit insurance in this economic downturn, which has come about because of the pandemic outbreak? Credit insurance has been used historically by many, has been utilized much more extensively in other parts of the world than in the US, in Europe and in Asia, in Western Europe, in England, France, Germany, and so on. Close to half of companies use credit insurance. Here in the US, it's been a much lower percentage, but demand has been growing dramatically. It's been growing for some years, but in the last few months, it's been nuts. I mean, we've seen more demand this year than ever before, which is a good thing because more companies are getting the benefits, but it's a challenging thing because, like with any insurance, if the time you start looking for it is when risks are on the rise. Claim volume. I mean, ever since the economic downturn of 2008, 2009, and its aftermath has been, since the end of that, since about 2010, the level of claims in the credit insurance business has remained relatively level. A surge is anticipated later this year. We have seen some growth in claims activity during the second quarter. It is anticipated that as we move into the third and then into the fourth quarter of this year, that there's going to be a lot more claims. Insurance companies paid claims after the 2008-2009 debacle, and no insurance company went out of the market. And we have no reason to think the insurers are not going to continue stepping up now. 2020 is not going to be the credit insurance industry's favorite year, but this is why they are in business, is to pay claims when things go bad. The thing I want to emphasize is that credit insurance had been a buyer's market. There's been a lot of capacity developed in the credit insurance market with all these insurance companies that I described in the earlier slide getting into the business, in anticipation of the U.S. market for credit insurance growing. There's been a lot of capacity, and that's made it a buyer's market. But since the outbreak of the coronavirus and its economic impacts, this has virtually overnight turned into a seller's market. Insurance companies are still underwriting, they're still issuing policies, but they're growing increasingly cautious with the recession looming. And it's unknown how long policies are going to continue being issued. So if you're even thinking about credit insurance, you may want to apply now. So what are the best practices for getting insurance companies to quote now, given that this has turned from a buyer's market into a supplier's market? Number one, when you apply for coverage, you want to bring in an equitable spread of risk, either expressing an interest to the insurance companies in covering all of your AR, or at least all of your largest customers. If you have 100 customers, that you at least want to cover your 10 biggest exposures. Insurance companies are not happy to look at companies that come in now trying to cherry pick, saying, well, out of all my customers, it's really these 3 that worry me, and those are the only ones I want to get insurance on. That was something you potentially could raise as a question before, but it's now in COVID times something that insurance companies are not keen on. You want to include a cogent cover memo with your application, describing the coronavirus's impacts on your company and your sector, clearly explaining any past dues. Are they due to coronavirus? Are they due to other factors? How likely are you to be able to collect? And to the extent you can show off any favorable policies or procedures or positioning of your company in terms of being able to collect, this is a time to strut that. And you want to have reasonable expectations. You want to show insurers a willingness to share risk. You want to be flexible regarding the terms and conditions of the policy, which you may not be able to negotiate as firmly as you might have been before the coronavirus. And bearing in mind, any coverage, any risk sharing that you can get now is better than none. To that end, you may be seeing insurance companies' quotes come out with a deductible or a bigger deductible than would have been there in the past. Indemnification percentages might be smaller. A policy that would have covered 95% of your AR of an invoice may now only cover 90%. Again, you're still getting a heavy risk sharing, but not quite as robust as before. Premiums have been increasing, understandably, but the rates are still low compared to the benefits of the insurance. It's still, in most cases, you're talking less than 1% of your invoice amounts to be insured. It's still, cents per $100 invoiced to get the coverage. Getting your buyers approved, some insurance companies, most insurance companies, once they approve a credit limit on a customer, that credit limit cannot be taken away by the insurance company throughout the policy year. Some insurance companies, their policies feature cancelable limits where the insurance company, based on information they hear in the market, can come to you and say, hey, effective 30 days from now, no more new shipments to this customer are going to be covered under this policy. It is more challenging now to get non-cancelable limits on customers. We push for that. We're trying to get that as much as possible for our customers, but if the only thing you can get is cancelable coverage, then it's still worth getting, because at least for however many months you can continue to sell with coverage on your customers, that's worthwhile. The same kinds of tips apply for getting your customer credit limits approved. Once upon a time, you could go to insurance companies and just say, hey, have you ever heard of my customer? What do you think of them? Can you just give me $500,000 approval added to my policy? Now you're positioning. Now, I'm not saying you cannot do that and still get a good result, but if you want to maximize your chances of getting your customers approved under a policy, you want to come in with more information. Your customers' financial statements, especially recent interim statements, credit reports, other information. Again, a little bit of a credit write-up. We're not talking about a book here, we're talking about a paragraph. But something giving a little bit of a credit memorandum, talking about your ledger experience, your history with your customer, the pandemic's impact on them, how essential is your product to them? In other words, how much leverage do you have to try and get them to pay if there's an issue? And again, we are still managing to get policies put together where insurance companies are giving the insured, the seller, the discretion to make its own credit decisions. If you can get that, even if the cost is a little bit higher, we recommend taking it because it gives so much flexibility to a seller that even if an insurer might be concerned about the sector or about a given customer, as long as you're getting paid reasonably well by them, you're able to keep being covered. How do claims work, particularly now in COVID time? Well, every policy, like we said before, has a claim filing window, a certain period of time during which claims can be filed. The policy spells out clearly how long that claim filing window remains open. Insurers are being flexible in COVID times. Some insurance companies are extending out their claim filing windows longer and so on, but you still need to comply with whatever it is. So if a given insurance company prior to COVID time said you can file a claim anywhere up to 6 months past due, if they've come in now and said, well, you can file a claim anywhere up to 9 months past due, that's a good additional flexibility, but you got to come in within the 9 months. You can't come in 9 months in one day and say, I want my claim to be filed. You've got to pay attention to the policy's terms and conditions. After you file a claim, after you incur a loss, whether you filed your claim yet or not, you need to be clear with the insurance company. And again, this is spelled out in the policy and in communication that happens after you've made an insurance company aware of a loss. You need to be clear on who's in charge of collecting. Are you, is it you who's in control of trying to get your customer to pay, or is the insurer taking that over? Either way, you've got to cooperate with the insurance company. You've got to do everything you can to help minimize the loss. When it does come time to file your claim, there's a claim form that every policy comes with. It's pretty straightforward. Who's the customer and what are the orders that were involved and what's been happening. At that point, you provide copies of your invoices and purchase orders and bills of lading and contracts and so on for the insurance company to see, what it is that your customer has repudiated by not paying you. And when it comes time for the claim to be paid by the insurance company, you assign the receivables over to them. You sign a release. Because, one of the big differences between credit insurance and other kinds of insurance is the possibility of recovery. With, say, a homeowner's insurance policy, if a house burns down, there are 0 future scenarios under which the house is going to unburn down. The insurer just has to take the loss. With credit insurance, there's a reasonable possibility that the insurer can recover, and that after they've paid your claim, which means you're done, you've been taken care of, they have the ability to go after that receivable. And their track record is pretty good. So this is an important element of understanding credit insurance. How do you make sure that you're going to get paid by the credit insurance policy? Getting credit insurance claims paid is a function of you complying with the policy. If you comply with your policy, credit insurance is going to perform as advertised. Now, the credit insurance policy has to be worded in such a way that it matches up with how you do business. And part of our role is to either negotiate policy wordings on behalf of the insured with the underwriters to make sure that the wording matches up with how the insured party does business. And or it may be incumbent upon the insured party, the company buying the insurance policy, to change some of its credit procedures to get them aligned with the policy's requirements. However, none of this is a reach. None of this is the tail wagging the dog. The majority of the terms and conditions in a credit insurance policy are consistent with just having cogent credit and collection practices in place anyway, that any business should have. A credit insurance policy is no greater than the sum of its parts. Yes, it has more moving parts than other kinds of insurance policies, but there's nothing hidden. There's no fine print. There's no hidden documents or anything. These are not long policies. They tend to be, 6, 7, 8 pages long in the main body of the policy, plus, the endorsements and declarations and so on. So it's possible to completely understand everything in your policy, and you need to. This is not like car insurance or other kinds of insurance that you may not read, and you just get the policy and stick it in a drawer someplace. Credit insurance policies should be read and understood, and it's totally possible to do so. They are comprehensible. And then you go forward and do business in compliance with the policy's terms and conditions. If you follow one guiding principle, you will be most of the way there in complying with the policy's terms and conditions, and that's to extend credit under a credit insurance policy with as much care as if you didn't have credit insurance. So just a brief comments on who we are so you understand where I'm coming from with my remarks. Meridian's been around since the early 1990s. We have two main activities. We're a specialty insurance broker focused on credit insurance, both accounts receivable insurance for sales domestically in the U.S., as well as export credit insurance for international sales. We also specialize in brokering political risk insurance for sales to foreign governments, for protecting assets that are located in other countries, and so on. We also broker surety bonds for international transactions, receivable put options, which are not insurance, but which is another way of protecting receivables against non-payment risks. Again, we've got a whole array of services that help with managing credit risk. On the other side of our business is trade finance, primarily export finance, cross-border equipment leases and loans, and so on for equipment, say, going from the U.S. to customers in emerging markets, and other types of international credit. In the U.S., we're headquartered in Los Angeles. We also have offices in New York and in other cities. And then our sister companies in Europe and in Asia, again, give us access to underwriting markets and financing markets all around the world. That concludes my prepared comments, but if anybody has questions, I'd be very happy to hear them and try to answer them.
Fantastic, Gary. Thank you very much. You mentioned about the company itself, almost 30 years in business, you yourself, over 40 years of experience in this area. It's clear that you know what you're talking about, and you've been able to help a lot of people with the issues. I failed to mention at the beginning, but I do want to mention that you received the President's E Award, and you do a variety of other work that connects you into both the exporting world and into the credit world. So congratulations on your continued success and expertise. We have a couple questions. One is related to kind of what's next. So I'm listening to what you're talking about. And so how do I proceed in terms of making a decision whether this is the right thing to do, and how do I reach out to get more information?
Well, we have a whole team of people who have different expertise and experience working with clients who are in different industries. So depending upon what industry you're in, give a call. You can use the information here. The main number in LA is on this slide. I'm on extension 124. If you want to call me, that's fine, and I can get you to whoever would be the best person to get started with. Doesn't cost anything to apply for credit insurance. So if you're interested in checking it out, we can talk to you about it and see, the cost is when you actually buy a policy. There's no cost to explore it.
Got it. That makes sense. Question related to controlling and reducing the amount of risk going forward. What are your general guidelines, considering what you framed up this conversation around is the uncertainty, and that everyone there's really no one that knows what's going to happen. So what's a company to do to better manage adding more debt risk?
There's no single answer to that, because it really depends on variable. I mean, you can look at the various factors that a given company is facing, and with a given customer, and we can give some guidance on that. It's difficult to do so across the board, because again, let's say you're a company who's been extending 30 days payment terms historically to your customers. And now you have a customer coming in asking you for 90 days or 120 days payment terms. That may be a really bad move. If that's a customer whose payment morality has been or now is becoming shaky, if you start giving that company 90 days payment terms on your invoices instead of the 30 days payment terms that you'd been holding them to, if they start paying you 60 days slow, then you giving them net 30 now means you're going to not see your money till 90. If you open up to 90 days payment terms with that customer, maybe you're not going to see your money till 150 days. And that will have turned out to have been a bad move to make, and maybe you should have really held the line. On the other hand, you may be in an industry where everything is shifting towards 90 days payment terms. And if you don't open up those 90 days payment terms like your competitors are, then even if your product is the favored product that companies would want to otherwise buy, your failure to get with the program could cost you the business. So it's really, we have a pretty good sense of what the variables are that are impacting these decisions, but it's different for each circumstance. And so we really need to look and understand the details of each company's situation in order to answer that question.
You mentioned about specific industries having different issues and challenges. How best to find that? Should it be through the person's or the company's own network, or is that something that you can assist with as well?
Well, clearly, if a company can talk to other suppliers in its own industry about, common customers that they both sell to or what's going on, that's going to be of the greatest value. We have hundreds of clients in many different industries. And so we certainly have a growing anecdotal body of information about what's happening. Not to paint with too broad a brush here, but, bricks and mortar retail, that's a tough nut right now, as opposed to online retail, which is doing quite well. Airlines. Credit to airlines is a very challenging decision to make right now, or to the maintenance, repair, and overhaul facilities, and that whole ecosystem of the commercial airline aftermarket. Having said that, Ex-Im Bank remains strongly open in that sector. The private sector underwriters are much tighter. Oil and gas is very tough right now because you've got the combination of a considerably slowed demand for their product, along with the after effects of the pissing contest that went on between Moscow and Riyadh, earlier this year. So it's not to say that certain sectors are absolutely not a good bet for opening up longer payment terms and taking more risk. But certainly there are those which are particularly challenged. Some which we're seeing doing quite well include, the medical sector, the care sector, the home improvement sector, any number of other markets. Like I said, online, digital, retail, manufacturing in a lot of sectors is doing quite well, because even though the movement of people across borders is a very uncertain proposition, there's still a ton of goods, trillions of dollars of goods moving around the world.
You bring up a really important point. It's beyond even the specific markets, say the brick and mortar retail or oil and gas that may be having a problem, but also the chain up to that, right? So maybe law firms that are heavily leveraged in industries that are having real struggles, they'll be tight as well.
Well, yeah, I mean, on a personal note, earlier in the pandemic, the first thing I noticed among, friends of mine and people I know is people who are in the gig economy who started to suffer. But as this has progressed, there's more and more white collar people, more and more people who are in professions who are out of work. And it's simply because, their firm, you mentioned lawyers, or this could be for any number of professions where the firm has simply had to cut back, for economic reasons. So there's growing amounts of people, even in the professions, who are out of work right now. Even though we're having a challenging time, like a lot of companies are, I feel very fortunate to have work when so many do not.
Sure. We're almost out of time. We've just got a few more minutes. Are there some success stories that you can point to that you've seen during COVID time that illustrate some of the key principles that you've laid out today?
Well, sure. I mean, I think a big one is what I described earlier is, there are these supply chains where a company here sells, for example, to a master distributor in another country, and that distributor in the other country historically has bought a lot of product at a time, had it in inventory, and then got it into the supply chain, where that master distributor then sells to the wholesale trade in that country or that region, and then they sell into the retail trade. And so you've got product closer to the end users in country. One of the big impacts with COVID is that the companies these distributors in other countries have not wanted to stock a lot of inventory. And it's because they're not going to be able to turn it around and get paid for it, before they have to turn around and pay their U.S. supplier. And so by U.S. suppliers going to their distributors in other countries and saying, look, we need to return to you maintaining the same kind of stocking profile of inventory that you were before. You were always keeping $500,000 of inventory of our products on hand and moving that through. And now that's shrunk to 100,000. Now you're expecting us to keep those kinds of amounts of inventory here. And that's not working. Besides which, customers are not able to come into stores in your country and find our product on the shelves because, that throughput's not there. But what we're willing to do for you is instead of giving you no payment terms or requiring a letter of credit or giving you only 30 days payment terms, we're now going to open up to 90 days or 120 days payment terms because we understand the challenges you're facing. So if that conversation is able to happen, for example, with credit insurance in the background so that the U.S. exporter can be confident that, even with these longer payment terms, that one way or another, they're going to end up getting paid. This has been successful in a number of sectors where we've seen U.S. companies able to continue moving their product overseas and having more of their product be in the supply chain in their customers' countries by becoming more progressive with their payment terms.
Got it. Makes sense. Just one final question, and then we'll go. How did it feel to get the President's E Award?
Oh, well, that was a few years ago. It was great. This is back under the Obama administration. The thing I've been involved with the federal government more recently, which has been really interesting, is the TFAC, the Trade Finance Advisory Council, which was started by Penny Pritzker, who was the Secretary of Commerce under President Obama, and has continued by Wilbur Ross, the Secretary of Commerce under President Trump. where it's a public-private partnership between a few of us in the private sector, mostly banks and other financial institutions. We're the sole, I'm the sole member who's from the insurance side. And what we do is we advise the Secretary of Commerce on things that the federal government can be doing to strengthen trade finance in the U.S. and in international markets. And I'm a big believer in public-private partnerships. The vast majority of what we do has nothing to do with the U.S. government, but for example, we broker more ex-im bank insurance policies than any other insurance broker in the country. So we very much see where the government can come in and play a role side by side with, not instead of, but and not even better than, but side by side with the private sector. So that's really been, I think, more recently for me, the most interesting interface, between us and the government. But we're involved in a number of initiatives. We have a strategic partnership memorandum between us and the International Trade Administration and so on. As you said earlier, while we're involved with helping many companies just with domestic sales within the U.S. and the credit challenges here, our roots, our DNA is in international trade. And certainly, well over half of the companies we work with, what we're supporting is their export business. And again, that continues now, even in COVID time. There's still a lot of trade going on.
Congratulations on the success. Thank you for taking the time today to share this really important information. If anybody's out there and you'd like to get a hold of Gary and his team, the information is there on the slide. You can find their information in the Global Chamber directory, or all else fails, you can find Meridian Finance Group online. And you can send us an email at info@globalchamber.org. One way or another, we'll get you connected. Gary, thank you again so much. And we wish you the best of your day. And for everybody watching around the world, have a great rest of your day wherever you are. Thanks, everybody. Thanks, Gary.
Sure thing. So long.
Take care. Bye-bye.